It is Monday, January 18th, 2021. It is 8 p.m. Pacific Standard Time, and so you know what time it is. It's time for a little bit of coin metal. And it was yet another non-virtual get your ass kicked at Jiu-Jitsu Monday. Did not do a whole lot of ass kicking, did not really get my ass kicked. But yeah, that was only because I didn't stay for any of the sparring or competition preparation rather afterward. And I gotta be honest, at least part of the connotation there being that it's like competitive training. I just want to get in some more reps, and I don't know. Like I said, that being the focus, I kind of I don't know about all that business. But anyway, one of these days, probably I don't know, if I go back in tomorrow, I may do that. But I'm starting to get that guilt, and I was feeling it before, where if I'm feeling really like capable and I got some energy left over and whatnot, that's usually when I'm starting to come into my stride with my jiu-jitsu. I've been down for injuries and other pauses in my training before, so it's a cycle that I'm familiar with. But I'm starting to get around to this part of the cycle where it's like I'm getting impatient with myself because I don't feel like I'm picking it up fast enough, and I know that the only other way to do that is to be doing more repetitions and, of course, putting it into live practice. And that's been a major point of, and it's been a big issue for me. I've managed to get up the courage to roll in a tournament once, and amazingly enough, I did not vomit beforehand. But I think it was because I sweated my ass off trying to make weight, while the guy that I went up against did not do so. And I was very disappointed because I thought I had to make weight for the match, or I wouldn't be able to compete. And then they just keep my money, non-refundable by then. And so I didn't want to let 100 and change go to waste, because that's what the entry fee was. And so yeah, I'm like, it was funny too, because I was walking through the locker room to find a spot to get ready at. And while I was doing that, I noticed this very large gentleman. He was about 5'8", 5'9", just really jacked, really muscular dude. And I used to work at a gym, so I got a little bit of an eye for things, and I'm like, man, that guy's he's pretty built. I feel sorry for anybody who has to go up against him. And of course, as the luck would have it, I had to go up against him. And he outweighed me by, I would say, at least 30, maybe 40 pounds. And he was not a white belt in any other martial art except for jiu-jitsu. He's like a, competitive judoku or whatever. Yeah, judoku, I think it is. Yeah, anyway, he's like competitive in judo, because he just swept me, no effort whatsoever. Assumed a really dominant position and just immediately went to work. Not a fucking white belt. Not like I was anyway. And so it was an interesting experience, but it's not one I necessarily am in jiu-jitsu to do. So, like I said, at some point or another, I may get back out and do another competition, but I am certainly not ready for it yet. Or at least I don't feel ready for it. Whether or not that matters when it comes about is another story. But anyway, so as far as what we did today, it was kind of goofy. I had a lot of difficulty with it. It's starting from a quarter guard position where you have your opponent in the quarter guard, and from there you're wanting to get a double grip on their legs, so like an underhand grip on both of their legs, and then transitioning that to bringing one of their knees up on your body, and then pushing that leg down to where you can get a grip on it. And the grip in particular, I was having difficulty with. It was what was it? A mini stomp, I guess was the name of it. It was just it's a grip that you get the feet on. And like I said, I think I was having the most trouble with that part. I just forced the guy's knee down with my hand to where I could get a fucking lockdown on it and called it good. I mean, in gi jiu-jitsu, that would be somewhat akin to a black belt escape, and I really like the black belt escape, but it was ending up on a kind of a weird position for dogfight, whereas normally you would be to where your opponent had maybe like an underhook and you have an overhook, or the other way around. And this one, you're like gripping around their thigh with a gable grip, and then from there getting a full grip around the body, and from there getting up to a full dog fight, and then from dog fight, without disengaging the gable grip around the waist, like standing up, or what is it? No, that's the part I kept getting wrong. Was I was trying to hold on to the grip, and the way to do it was to have your left hand on their hip, but put your right hand down, post on the right hand, and then bring your leg around their bring your left leg around the back to where you get your hook in, and then from there, like leaning back and getting their arm in like a baseball bat grip. And like I said, I had a lot of trouble with it. It was there were some things that were familiar with it. Like all the individual elements, like getting a hook in. Okay, yeah, I know how to get a hook in, but getting a hook in from that particular position was kind of new to me, and I think that I don't know, it's just weird, And then like I said, there's a whole bunch of little elements that I know the elements themselves, but putting them together in this particular combination, in this kind of order, was very difficult for me to grasp a hold of. I'm still feeling kind of jumbled from it, even though I did the thing like, I don't know, at least like 10 times, maybe 15, somewhere around there. But yeah, I don't know. I guess it's one of those things that'll eventually get via osmosis, that are just managed to get around to doing it in just a drilling situation with somebody for an hour and change or so, and maybe then I'll get it. But yeah, anyway, it was a good session. I felt like I got a really good workout, and I think that in the future I may in fact use that. The grip on it was kind of weird for me, and one or two parts of the transition were kind of difficult. But there were elements of it that I really liked, and I actually got it right once or twice. And out of the 10 plus times that I did it, I got it right once or twice. And when I did, it felt really, really good. So yeah, like I said, I think that'll probably be something that ends up in my quiver. Anyway, let's go ahead and throw down with some music. And we're going to start with some body count for our first dance, because that's just what we do. And as far as what song we're going to start with, though, I think this one is appropriate. Talk Shit, Get Shot, First Dance, here on Coin Metal. And that was Pantera with No Good. And so, as far as what we're going to get into today, as usual, got a whole ton of tabs open in like all of my browsers, and so as far as like sorting it all out and kind of cobbling together a thesis as a voice of the day kind of thing, I have done exactly that. And so, I think I've said multiple times on this show that I do not consider CBDCs to be a successful venture, or something that will really take off as far as, the new money. Like, the only way that I think that they would be able to get people to use CBDCs is if that's what you were getting in the stead of US dollars or, Chinese yen or whatever, and you just didn't know. Like if you had like $200 in the account, that they would count it as $200 worth of CBDCs, and you would recognize it as $200 because that's what they're demonstrating. That's what they're showing you on the display. That would be about the only way that they could do it. And I don't believe that they're actually a viable thing in the longer term, only because if you look at it in terms of what the goals are of a CBDC, that they would be able to regulate commerce via which transactions that they actually allow to go through. They monitor your monetary activity and all that other bullshit for whatever inane reason they might actually have for doing so, or whatever excuse that they've given you for wanting to do so. But anyway, when you look at it in terms of that, it's like, okay, well, I got a choice between I'm going to pay for things with this CBDC that I'm going to get monitored and taxed on and surveilled and all that other shit, or I could use physical notes. Well, shit, if I can use physical notes, then that's exactly what I'm going to do, because it doesn't have the same paper trail, quote unquote, as the CBDC does, or a Visa transaction for that matter. And so when you're looking at it in terms of that, it's like then you look at cryptocurrencies, the thing that CBDCs are supposed to be trying to compete with, and you recognize that there are multiple altcoins that you could be using without any surveillance on your transactions at all, and no taxation on your transactions that you and your partners in commerce don't explicitly or implicitly agree to. But the point being that the control over the transaction is yours, and there's none of this, we're going to censor your transactions, we're going to, surveil your bullshit, whatever. If you're doing it in cryptocurrencies, certain ones, there are others out there that these people are tracking and whatnot, and I'm not going to name any specifics on there except to say that there are such things as privacy coins explicitly for this reason. And so, again, this whole idea that they're going to put a gun to your head and say you're going to transact in CBDCs, they're going to criminalize like 4/5 of the planet overnight, because all of you, and I don't care who you are, all of you are conducting commerce that's not being denominated specifically in physical notes. It's like a product of being human. If you talk to another human, you've conducted a transaction. Whether or not it was actually business oriented or anything like that, it's a whole different thing. But the possibility is there that such a thing can take place. That you can make an agreement that the only people who are aware of it are you and your partner in commerce. Or partners, as the case may be. So anyway, I got this thing here. It's on decrypt.co. IMF survey takers say CBDCs are not money. This is by Sharia Malwa, and I'm just going to go by the name and suggest possibly no penis or vagina. No, penis. All right. and it was authored on January 18th, 2021. A Twitter survey by the International Monetary Fund, IMF, on Sunday saw the financial regulator and watchdog ask its 1.7 million followers, are central bank digital currencies really money? The answer was one-sided. Nearly 65% of the 30,800 respondents as of Monday morning voted a clear no. The comments were mainly from crypto evangelists, meaning the data may be biased, with some popular influencers even stating that such currencies were, quote, scams. CBDCs are centralized digital versions of fiat money. They are similar to stablecoins, which are pegged on a one-to-one basis with a particular fiat currency. Only China has officially issued their own digital currency so far. That's not true at all. Venezuela did it like a year ago or so. Anyway, continuing. In the same Twitter poll, the IMF added that central banks would face regulatory headwinds while issuing their digital currencies. Quote, while central banks examine the case for developing a digital currency, many may not be allowed to do so by their own laws, the IMF said, adding that 80% of the world's central banks were authorized to only issue, quote, physical cash. As shown in the below image, only 40 countries have laws to issue digital currencies, while the framework for such advancements is, quote, not clear in 27 countries. Let's see here. Looking at a pie chart here, and see, law does not limit issuance on banknotes and coins. 40 central banks, that's 23%. Law is not clear, 27 banks, 16%. Law only authorizes issuance of banknotes and coins, 104 central banks at 61%. However, what separates paper money from digital money? As per the IMF, all citizens should be able to easily access financial services, and in the case of digital currencies, they must necessarily have digital means, like mobile phones, laptops, internet, etc., to access such services. And since the ownership of these devices cannot be imposed by any government, the issuance of digital currency becomes a significant legal one. Another issue, the IMF said, was that digital currencies could mean a country's citizens have their bank accounts with these central banks directly, as opposed to today where accounts are held by banks whom in turn have accounts with central banks. And to this, the concerns of taxation, insolvency laws, and payment systems and CBDC issuance becomes a, quote, complex legal challenge. And see, Mags says, have you guys been getting into the IMF polls? 34% said no, 66% said no, 34% said yes. Are digital currencies really money? And I guess that was IMF's. 80% said yes. Yeah, I doubt that. Meanwhile, such issues are not phasing central banks from their CBDC aims. China has been aggressively developing its CBDC since 2015. Its digital yuan is currently being extensively tested within the country, while Japan, South Korea, Singapore, and others started such work in 2018 to 2019. Officials of the U.S. government itself showed interest in developing a state-backed digital dollar last year, but not all countries are excited at the prospects of their own digital currencies. Yeah, and they really shouldn't be. You know, I think the only reason why the Chinese one actually quote-unquote works is because they are lying. You know, they're like creating quote-unquote liquidity on the fly. that they don't necessarily have collateral for or even extended expectation of returns to cover for collateral. These are the kinds of things that cause massive jumps in your waste, fraud, and abuse. And the fact that their government is the companies, and the companies are like emissaries or aspects of the government in China, that it's like it makes the entire kind of corruption like an endemic part of the whole system. And now, while within China that may work for them, it's the outside world that has to contend with how their internal policies affect their currency in the global market. And personally, I don't think that they'll be able to be any more honest than you would expect a U.S. bank or somebody like that to be, with regard to their solvency status and all that. The fact of the matter is that we have yet to see a single stablecoin that has produced a full audit of their reserves. Not a single one. Not even USDC, which is actually run by Goldman Sachs. So, what does that tell you? It tells me that there's a good potential that what they're counting as collateral is actually assets, i.e. your assets, from elsewhere in their portfolio. I don't trust them to be using money that is theirs. I expect them to be using some sort of new product that they've been making available to their customers, and their customers don't understand it, but hey, they say, this is a really good product and we think it's going to make a lot of money, and it says, okay, I'm looking for some ROI, I'm looking for return on investment. Don't really care about where it's coming from. So, of course, I invest millions of dollars in this new product, or at least and I have no idea that it's anything involving quote unquote stable coins, and I don't know the right questions to ask to check. So yeah. Anywho, as far as what else we're going to get into today, I caught the title of this, and of course it sounds like terrible FUD, but I want to entertain it with a little airtime anyway, because it does sound like delicious FUD, and I'd like to annotate it if it is in fact such. Anyway, here it is: The Bit Short, Inside Crypto's Doomsday Machine. And this is by Crypto Anonymous 4 days ago. And so yeah, here we go. This is the story of a Bitcoin trade, the most financially impactful trade I've ever made in my life. It's also the story of the deep yet frantic investigation of the crypto ecosystem that led me to make that trade. And it's the story of what's really going on in crypto and what we should do about it. If you own meaningful amounts of cryptocurrency, or you're considering buying some, you're the reason I wrote this. Please do read to the end, and we will. Prologue: Tether and Company. Before I begin the story, there's a little bit of background you need to know first. There are things in crypto right now called tethers. To simplify a bit, tethers are issued by a crypto company called Tether Ltd, meaning that if Tether Ltd says you own a tether, then you do. Tether Ltd also says one tether is worth exactly $1. Can they do that? Well, they say they can because they hold $1 worth of assets for each tether, but are those assets actual dollars? No, they are not. So what if the assets go down in value? Don't worry, they will not. Okay, but can we at least see these assets? No, you may not. Who in their right mind would use something like Tether? Well, the short answer is that many people use Tether to buy Bitcoin and other cryptocurrencies. The long answer, though, is astounding, but more on that later. Because Tether sounds exactly like a currency fraud, it may not surprise you to learn that Tether Ltd is currently under investigation by the Office of the Attorney General for the Southern District of New York. That investigation was announced to the public on April 25th, 2019. Dude, we've known about them chasing after Tether for a lot longer than that. The trade. Now, fast forward 1 year, in March of 2020, I bought a large amount of Bitcoin. At the time, I saw market dislocation and the likelihood of significant dollar inflation due to the U.S. government's likely response to the unfolding plandemic. I suspected Bitcoin would be inflation resistance because of its enforced scarcity. To the extent that I thought about Tether at all, I remembered that the OAG's investigation assumed Tether was now old news and would surely have been pulled from the markets, and dismissed it as a factor in my buying decision. That was a huge mistake. The HODL. For the rest of 2020, my inflationary thesis looked right. Unrest in the United States combined with anticipated high levels of lending and consumer spending post-pandemic seemed likely to fuel substantial USD inflation in real terms through the end of 2020. During the same period, Bitcoin was becoming increasingly scarce on a secular basis. The market appeared to agree with my thesis. My Bitcoin position doubled in value and then doubled again. By the end of the year, I was sitting on 600% gain and decently wealthy in nominal dollars. I had intended to hold my Bitcoin for the very long term. It never even crossed my mind to sell it, regardless of its day-to-day price variations. And then, in early January, a forum post caught my eye. The shock. On January 8th, I saw this post on Hacker News about Tether manipulating the price of Bitcoin. And let me right-click on that one. That shook me. I'd assumed Tether had been purged from the crypto markets, yet apparently it was still around. But how much Tether could there really be in the crypto markets? Surely not that much. Still, I took a look, and the answer, I was surprised to see, was a lot. The left-hand side of this chart shows which currencies are flowing into Bitcoin, that is, are being used to buy Bitcoin across all crypto exchanges. The right-hand side shows which currencies are flowing out of Bitcoin, that is, that Bitcoin is being used to buy. The chart is showing typical numbers for early January 2021. Let's see, about 10.9 or 0.09 billion tether to Bitcoin was 10.09 billion, and then from Bitcoin to Ethereum, Binance USD, XRP, Litecoin, Qcash. What the fuck is Qcash? I'll have to check that out sometime. And then a much smaller percentage, it looks like, of the US dollar and Japanese yen and Euro British pound. Okay. The left-hand side of the chart shows the currencies flowing into Bitcoin that's used to buy Bitcoin across all crypto exchanges, and the right-hand side shows which currencies are flowing out of Bitcoin, that is, that Bitcoin is being used to buy. The chart is showing typical numbers for, yeah, we got that part. The upshot, over 2/3 of all Bitcoin, 10 billion worth of it, that was bought in the previous 24 hours, was being purchased with Tether. What's more is, this pattern wasn't unique to Bitcoin. I saw the same thing for all the other popular cryptocurrencies. It seemed I'd been wrong to dismiss Tether. Tether wasn't just in the crypto markets, Tether was the crypto markets. The panic. This worried me. Most of my wealth was exposed in the form of Bitcoin, and Bitcoin seemed like it might be exposed to Tether. And Tether's issuing company was under active investigation. I urgently needed to find out if this risk was real. I cleared my schedule and started digging. Right away, it was obvious that if Tether flows were partly or wholly fraudulent, that would have a significant effect on the correct market price of Bitcoin. Even though $10 billion of Tether flows only constitutes 1.4% of Bitcoin's $700 billion nominal market cap, all that really matters is what fraction of Bitcoin's daily buying volume Tether accounts for, and that number is closer to 70%. How could I find out if Tether was fraudulent? One quick proxy might be what kinds of exchanges it traded on. I knew that some exchanges, like Coinbase, used solid due diligence to curb money laundering, while many other exchanges weren't as well run. Was there a pattern to which exchanges supported Tether and which ones didn't? There was. Here's how the crypto trades flow through Coinbase Pro in a typical 24-hour period. And it goes from, US dollars primarily to Bitcoin, then to XRP and Ethereum, and a whole bunch of altcoins, it looks like. Okay, so notice that the money going into crypto is almost all dollars, euros, and British pounds, currencies that are subject to rigorous controls by their countries' respective authorities. And here are the flows of crypto trades through Binance, BitZ, HitBTC, the three biggest crypto exchanges in the world by nominal volume. Okay, gives us some charts. The pattern was obvious. Practically all the crypto sold on these three exchanges was being bought with tethers. Not at all what was being bought with USD, or none at all was being bought with USD. And the volumes were huge. Coinbase Pro is responsible for around $4 billion in crypto trades each day, but Binance alone accounts for over $50 billion worth of crypto volume, and each of the other two exchanges is bigger than Coinbase. Most of the crypto that gets bought each day is getting traded for tethers on those exchanges. That's not actually a bad thing. What they're probably doing is, instead of trading against US dollars, they're trading in USDT, because if they do trade against US dollars, those could possibly be rendered as taxable events. Whereas doing so against Tether does not have that same issue. Continuing on, Binance, BitZ, and HitBTC are unbanked exchanges. That means they don't have direct access to the U.S. financial system, most likely because no U.S. institution is willing to serve as their correspondent bank domestically. Actually, it's because they've been prohibited from doing so by the NYDFS, but we'll probably not get into that today. Binance US is an affiliate of Binance, does allow dollar purchases, but its daily volume is only 10% of that of Coinbase, and less than 1% of its offshore counterpart, so its effect on the crypto markets is negligible. It's hard for crypto exchanges to get banked, but Coinbase, Bitstamp, and several other high-quality exchanges manage it by maintaining strong Know Your Customer and anti-money laundering controls internally. But what I found most alarming was that neither of those two most reputable USD-banked exchanges, Coinbase and Bitstamp, supported Tether trades at all. If Tether was on the level, there'd be no reason for them to forego the fees on that trading pair, unless their risk and compliance departments had deemed the token too much of a liability to carry. The deep dive. By now, I was concerned that my Bitcoin position might be too risky to hold, but I still needed more evidence before I unwound such a big trade. I had to get more context on Tether, context that was free of marketing distortion as possible. I found what I was looking for in the case docket for the New York OAG's ongoing investigation of Tether Ltd. Note that the inquiry's respondent is listed as iFinex.Inc. et al., rather than Tether Ltd. on the docket, for reasons that aren't worth getting into here. That's not true. iFinex owns Tether and Bitfinex, so there you go. I'll skip most of the content. I strongly urge you to review the files for yourself and just list the 3 biggest takeaways that jumped out to me. On February 26, 2019, 2 months before opening its official investigation, the OAG requests a large number of documents from Tether Ltd. The purpose of the request is to help the OAG understand how tethers are being issued, backed, and accounted for, and how tethers are flowing through the crypto ecosystem. From the beginning of the official investigation on April 25, 2019 through July 9, 2020, a period of nearly 15 months, Tether Ltd. Issues a series of legal challenges to the investigation that appear designed to delay their response to the OAG's document request. On July 9, 2020, the New York Supreme Court dismisses Tether Ltd.'s final challenge on appeal, effectively forcing Tether Ltd. To comply with the OAG's document request. What's more, Justice J. Gesmer's opinion eviscerates all aspects of Tether Ltd.'s arguments, good commentary here, suggesting that Tether Ltd.'s appeal was neither intended as a realistic challenge to the documentation request at all, but it could, plausibly, have been part of a strategy to delay the document disclosure by any possible means. Things were looking bad. But then a question suddenly occurred to me. Did any other significant event happen to Tether on or around July 9th, 2020? So I looked, and I found something. The chart above shows the market cap of all issued tethers between January 13th, 2019 and January 13th, 2021, the blue curve, because one tether nominally equals $1, the total market cap of Tether in dollars is always equal to the total number of tethers. The number on the y-axis don't refer to the market cap, but for scale, the highest point of the blue curve corresponds to around $25 billion. The red arrow on the chart points to April 25th, 2019, the announcement of the OAG's investigation. Notice how, as the investigation progresses, the issuance rate of Tether begins to rise, initially in large single blocks of around $1 billion every few months. The second arrow on the chart is July 9th, 2020, the date of the New York court ruling forcing Tether Ltd. To begin the process of disclosing its documents to the OAG. 2 weeks after that ruling, Tether Ltd. Issues one more large block of tethers, nominally worth around $800 million. And shortly after that, on September 1st, the issuance pattern for tethers changes completely. Beginning in September, Tether Ltd. Begins to issue multiple large blocks of tether per day. The pace accelerates with $2.3 billion worth of tether issued in the first week of 2021 alone. This was consistent with the possibility that as Tether Ltd.'s various legal challenges failed, one after another in the New York courts, Tether Ltd. Was choosing to issue tethers faster and faster to maximize the amount of value it could extract from the crypto ecosystem before being shut down. The pace accelerates closer to Tether Ltd's final disclosure deadline, January 15th, 2021. I still needed to answer one last question. Did Tether issuance actually correlate with the price of Bitcoin? At a glance at the charts gives me a clear affirmative answer. And that could explain something else, though. It could explain that the price of Bitcoin was going up, and so the tethers were issued in order to depreciate the price of Bitcoin, not cause it to go up. Continuing on. There are three major periods of high relative tether issuance on this graph. Number 1, April 29th through April 2019 through July 2019. 2, April 2020 through July 2020. And 3, September 20th through to the present. All three periods overlap with visible increases in Bitcoin's market price. The red arrows here point to these same two dates on Tether's chart above. This wasn't a conclusive pattern. It still didn't prove that Tether issuance was causing Bitcoin's price increases. It was still possible that the retail demand for Bitcoin was driving real USD into Tether Ltd through some unknown mechanism. That Tether Ltd was issuing tethers in exchange for those dollars, and that those issued tethers were then being used to buy Bitcoin. Under that scenario, Tether's rise was being caused by Bitcoin's demand, and Tether might be fully backed by dollars after all. Nonetheless, based on this evidence, I concluded my risk was now too great. I was now long Bitcoin up to my eyeballs. Bitcoin was clearly correlated with Tether. Tether was clearly being issued at a frantic rate, and that issuance had a high probability of being backed by nothing at all. I made the call. It was time to get out. The exit. On January 9th, 2021, I liquidated my crypto position for USD. In the process, I locked in a dollar-denominated gain that, in the interest of full disclosure, I can only describe as life-changing. At this point, I still didn't grasp the entire picture. For example, I still thought there was a chance that Tether could be backed by real assets. My state of belief was something like, of these 70% of Tether flows into Bitcoin, some fraction is real. Some fraction is real but illicit, buying drugs and such. Some fraction is pure fiction. I have no clue what the respective fractions of each are, but I do know that my personal risk threshold has been exceeded. I was still a bit concerned that I'd miscalculated. Tether might yet be largely real, and if it turned out that it was, I'd have missed the boat. And then, by pure luck, I had a conversation that blew my mind. The epiphany. I was catching up with my friend Bob, pseudonym, over video chat. I just sold my Bitcoin position and was nervously awaiting confirmation from my bank that my USD wire transfer out of the exchange had cleared. Crypto was on my mind, so I asked Bob about it. The conversation went something like this. Me. You don't own any crypto, do you? I'm concerned that some of the exchanges in the ecosystem might be fraudulent. Bob. I actually have a whole bunch of crypto on this exchange called Bybit. Do you know if that's one of the risky ones? Me. I'm not sure. Does it let you trade in US dollars? Bob. No, but a lot of other exchanges don't either. In fact, you can't even deposit US dollars directly into a Bybit account. Me. Really? But then how do you get your money onto their exchange at all if they don't accept US dollar deposits? Bob. You send your US dollar to Coinbase and buy Bitcoin with it. Then you move your Bitcoin into Bybit and trade with it there. Me, hold on. If that's the case, then why would anybody ever use an unbanked offshore exchange that trades purely in crypto? What does Bybit offer you that Coinbase doesn't? Bob, leverage. I personally only use 2 to 3 times leverage, but they let you leverage your positions all the way up to 100x if you want. You can't do that on Coinbase. Me gasps audibly. Bob, they also do a ton of promotions. They've got a bunch of timed missions where you can earn tethers for doing stuff like inviting friends onto the exchange, joining their Telegram group, or trading on their platform. Me, holy shit. Bob, but thanks for the warning. I'll pull my crypto out as quick as I can. It might take me a few minutes though. I'll need to fire up my VPN first. Me, a VPN? But why? For the love of God. Bob, because I need to spoof a Bolivian ISP to access the exchange. They're illegal to use if you're based in America. Me, head explodes. There's a scene in The Big Short where Mike Baum meets a stripper who's taken out mortgages on 5 properties. The stripper doesn't think there's anything wrong with doing that because her mortgage broker told her she could always refinance her mortgages when the prices of the houses went up, and housing prices would always go up. Up to that point in the movie, Mike's investigation had revolved around bonds, mortgage rates, and CDOs, but meeting that stripper personalizes the market for him for the first time. Mike sees one of the human beings who's on the other side of his mortgage trade, and that's what finally convinces him to short the housing market. For me, that's what talking to Bob represented. For the first time, I'd seen what it felt like to be on the receiving end of crypto's doomsday machine. The smoking gun. Talking to Bob changed my perspective on Tether. I no longer viewed Tether as a source of excessive risk. I now viewed it as a highly probable fraud. Part of the reason was the incentives. The Tether-denominated amounts that Bybit, Binance, and other similar exchanges were giving away to people like Bob seemed inconsistent with the revenue those exchanges could expect to generate from the average user. To get a sense of the giveaways, I ran an anonymized Google search for Binance promotion. This returned as one of its top results a Binance.com page that read in part, quote, "We have a special end-of-the-year promotion where we will offer eligible users a savings voucher worth 500 USDT. Holy shit, that is a lot. On the other hand, a similar search for Coinbase promotion returned 0 first-page results hosted on Coinbase.com domain. This suggested that the offshore exchanges might be more willing to give away tethers than Coinbase was to give away US dollars, which implied the offshore exchanges were placing a lower value on tethers than they should be. Now that I knew what to look for, everything started to fall into place. First, I found this Twitter thread pointing out that tethers were being issued in exact perfect round number blocks. In the screenshot below, USDT is a ticker symbol for Tether. And it's showing, 400 million, 400 million, 400 million. Yeah, that's all on Whale Alert. This is unusual. If demand for tethers were real, one would expect Tether Ltd to combine together multiple USD deposits from investors into a single issuing block. Combinations like that shouldn't add up to perfectly round numbers every time. What's more, the supposed USD inputs, ergo 401,431,056 US dollars in the top left transaction, are giving perfectly round Tether outputs, 400 million USDT in the same transaction. In every block, regardless of the prevailing exchange rate or anything else. By itself, this is implausible, but when you compare it to the issuing pattern for USD coin, Coinbase's own issued stablecoin, which is backed by regularly audited reserves of real dollars, supposedly, the difference is stark. In the screenshot below, USDC is a ticker for USD coin, and that's actually circle. USDC isn't Coinbase's own coin, it's Goldman Sachs' own coin. Let's see, 9,374,133 USDC for that many USD was minted at USDC Treasury. Okay, yeah, and it's showing that they're all weird numbers. They're not rounded numbers like Tether. And you know what? That could also be due to a difference in issuance policy. Anyway, continuing on. Coinbase issues its USD coins very differently from how Tether Ltd issues its tethers. The issuing blocks for USD coin are smaller, and their size varies more. Tether's blocks range in size from 150 million to 400 million tethers, while USD coins blocks range from 7 million to 60 million USD coins. The issuing blocks for USD coin also have random-looking numbers of coins in them. That randomness is what you'd expect if Coinbase was pooling real USD demand from a bunch of unrelated investors together in each issuing block. The last nail in the coffin was when I found out about the lack of visible reserves. If Tether Ltd really was taking in $1 for each tether it issued, then it should have as many dollars in its bank account as there are issued tethers. And it turns out that we can check if this is true. Tether Ltd's bank is Deltec Bank in the Bahamas, and the Bahamas discloses how much foreign currency is in its domestic banks hold each month. The answer was, at least up to the end of September 2020, not nearly enough. From January 2020 to September 2020, the amount of all foreign currencies held by the domestic banks in the Bahamas increased by only $600 million, going from around $4.7 billion to about $5.3 billion. The table is in Bahamian dollars, but the Bahamian dollar is pegged to the US dollar, so 1 BSD equals 1 USD. But during the same period, the total issued tethers increased by almost $5.4 billion, going from $4.6 billion to $10 billion. The implication was shocking. There weren't nearly enough dollars in all the domestic banks in the Bahamas to back the tethers that were floating around in the crypto market. So this was crypto's big short. Tether Ltd was short of US dollars to the tune of about $25 billion. The big picture. After this latest round of research, I waited anxiously. I'd sold out of my Bitcoin position, but my bank wire was still in transit. I'd still face counterparty risk until I'd fully exited the market. I was now convinced I was built on a fraud. While I waited, I combined what I knew of Bob's experiences with my other evidence, which allowed me to build up a mental picture of the fraud's core money-making engine. Here's how it would work. Bob, a crypto investor, puts $100 of real US dollars into Coinbase. Bob then uses those dollars to buy $100 worth of Bitcoin on Coinbase. Bob transfers his $100 in Bitcoin to an unbanked exchange like Bybit. Bob begins trading crypto on Bybit using leverage and receiving promotional giveaways, all of which are Tether denominated. Tether Ltd. buys Bob's bitcoins from him on the exchange, almost certainly through a deniable proxy trading account. Bob gets paid in tethers. Tether Ltd. takes Bob's bitcoin and moves them onto a banked exchange like Coinbase. Finally, Tether Ltd. sells Bob's bitcoin on Coinbase for dollars and exits the crypto markets. Yeah, that's similar to the scheme that I've described. Anyway, continuing. My guess is that Tether Ltd., through proxy accounts, is only responsible for a small fraction of the direct buying activity on those exchanges. But with 50 billion in nominal value flowing through Binance every day, even a small slice of the flow represents huge amounts of revenue. And when your business involves trading fake dollars for real ones, your profit margins can get pretty high. In the example above, Tether Ltd. bought Bitcoin from Bob at its nominal price in tethers. But that Bitcoin was the cover charge Bob paid to get access to truly staggering levels of leverage and promotions from the exchange. And that very leverage and those very promotions are all denominated in tethers. Tethers that I suspected Tether Ltd. is handing over to the exchange in huge quantities to help it subsidize its user acquisition through more promotions. This explains how Tether's been able to maintain its $1 US peg, $1 USD peg on the unbanked offshore exchanges. For a given amount of Bitcoin, a crypto trader gains effective access to far more tethers than the public exchange rate would justify. The exchanges then book those extra tethers as leverage and promotions, allowing them to maintain the friction that those, quote, free tethers aren't being traded for Bitcoin at all, even though they are part of the package Bob receives for the Bitcoin he sells. Viewed from this angle, the fact that the offshore exchanges don't support USD is a feature, not a bug, preventing USD and Tether from meeting on a transparent market is crucial for ensuring that the true price of Tether stays opaque, making it hard for an outsider to dispute its $1 peg. Forget activity on the offshore exchanges for a moment and just think of a simple mental picture. Imagine that you could stand at the metaphorical booth where Coinbase's exchange connects with the US financial system. If you could do that, you would see two lines of people at the booth. One line would be for crypto investors putting dollars in, and the other line would be crooks taking dollars out. About an hour after I wrapped my head around the whole colossal mess, I got a notification from my bank. My wire transfer from the exchange had cleared. I was out of trouble. I was out of the trade. Epilogue. In the land of the blind. In my day job, I'm the founder of a fairly successful startup. As a result, my experience on Twitter is heavily weighted towards seeing posts by other founders and venture capitalists. By and large, those folks are well-meaning, highly intelligent, and deeply competent in their understanding of the market. And yet, this section of the crypto tweets from my startup community is pretty typical. And this is by Naval: Bitcoin cannot be coerced. That's why it's the most important experiment in the world. And see, Balaji's.com says Bitcoin is scarce, dollars are abundant. Alexis Ohanian Sr. says the Bitcoin dream is very, very much alive. I don't know. I'd have to challenge that one. Connor White Sullivan says, a thought which occurred to me last night, would Jesus buy Bitcoin? This seems a pretty solid critique of fiat currency here, and it gives us a Matthew quote. Let's see. Austin Rief says, interesting to see what the price Bitcoiners flex their old tweets, screenshots, and videos hyping up Bitcoin. The real gangsters are the one who are holding out for 100K to flex. These are well-respected members of the community. I don't know who you're talking to. I've met a few of them personally and have always come away impressed by their goodwill as well as their insights. What's more, I must admit I've expressed similar sentiments about Bitcoin myself in private during the latest bubble. So what's going on here? What could be blinding our community to fraud on such a scale? Part of the answer, I believe, is illiquidity. An illiquid market is one you can't cash out of quickly. The startup ecosystem is very illiquid. It takes years to decades for founders to cash out of the businesses they build. Startup founders and the VCs who back them mostly have experience dealing in illiquid markets. Crooks don't like illiquid markets. Crooks like being able to cash out fast. The longer they stay in one place, the higher the chance they'll be caught and arrested because they are crooks. Since illiquid markets repel crooks, the illiquid startup ecosystem turns out to be large, though not completely free of crooks. That's part of what makes it such a pleasure to work in. But it also means that the community has never developed a great collective radar for fraud. It hasn't needed one. But the startup community has a fantastic collective radar for things that, number 1, start small, number 2, grow fast, number 3, challenge the status quo, and number 4, are broadly misunderstood. Those are the features of a promising startup. And the community has learned that it's expensive to miss out on one of those. Unfortunately, those are also the features of a fraud. But the startup community doesn't encounter much fraud, so it tends to discount the possibility, and in crypto, that's a grave mistake. Unlike startups, crypto is a highly liquid market, exactly the kind that attracts crooks. And crooks like to do fraud. And that means that many things in crypto look like promising startups are actually frauds. But it's more than that. On top of everything else, crypto really is promising technology. There's value to decentralization and censorship resistance. There's value to trustless enforcement of contracts. And there's value to having a selling point for a scarce asset. The startup community is currently recognizing that this potential value exists, but without good fraud radar, it has no way to estimate how much of that value is real today. I believe the startup community is about to have its fraud radar recalibrated. That recalibration and the exorbitant fee the market will charge for it will be mandatory for anyone who holds a meaningful amount of crypto. So where does all of this leave us? There are a few remaining questions. Can we break this fraud right now? Is there a way for us to collapse this fraud quickly so that fewer people get hurt by it? I believe that there is. The legitimate crypto exchanges like Coinbase and Bitstamp clearly know to stay away from Tether. Neither supports Tether on their platforms, and the feeling is mutual. Because if Tether Ltd were ever to allow a large liquid market between Tethers and USD to develop, the fraud would instantly become obvious, and everyone as the market clearing price of Tether crashed below the $1 peg. Kraken is the biggest US dollar-banked crypto exchange on which Tether and US dollars trade freely against each other. The market in that trading pair on Kraken is fairly modest, about 16 million worth of daily volume, and Tether Ltd surely needs to keep a very close eye on its movements. In fact, whenever someone sells Tether for US dollars on Kraken, Tether Ltd has no choice but to buy it, and to do so otherwise would risk letting the peg slip and unmask the whole charade. My guess is that maintaining the Tether peg on Kraken represents the single biggest ongoing capital expense of this entire fraud. If the crooks can't scrape together enough USD to prop up the Tether peg on Kraken, then it's game over, and the whole shambles collapses. And that makes it the fraud's weak point. To be crystal clear, every time you sell tethers on Kraken, you are forcing Tether Ltd to pay you in US dollars. If you can manage to sell enough tethers for US dollars on Kraken, then Tether Ltd will run out of dollars, and this whole machine, which currently undergirds 70% of all crypto trading flows, will fall apart. Well-capitalized hedge fund managers may wish to reread the above paragraph and ponder its implications. How can we stop this from ever happening again? I have a few suggestions. The New York OAG should seek an injunction from the courts blocking any further issuance of tethers. This should be done as soon as humanly and legally possible. Not only are the livelihoods of countless people on the line, including those of thousands of Americans and their dependents, but allowing a USD equivalent pseudocurrency to be minted without backing or restriction puts the nation's ability to regulate its own currency flows in jeopardy. To be clear, U.S. authorities should be extremely concerned about this. To a good approximation, there is currently an unregulated foreign entity printing dollars with impunity. There's a case to be made that this constitutes a direct adversarial attack on the US dollar, and the longer it goes on, the more risks impugning the integrity of the entire US financial system. Pardon me there. The U.S. Treasury should enforce 100% reserve requirements on all U.S. dollar-pegged crypto stablecoins with mandatory audits. There's a lot of genuine potential in crypto. The startup ecosystem got this part right, but that potential won't be realized if the industry is riddled with frauds. That's not true. I mean, it's gotten this far and it's been full of frauds the entire time. And while overregulation is a real concern, the fact this racket has gone on for so long and at such a scale is a clear sign that we need a mechanism to validate the reserves of a stablecoin issuer. Healthy regulation makes an ecosystem more valuable, not less. According to who? Healthy regulation? What determines the difference between healthy regulation and overregulation? I can't see that there is a difference. Fuck you. Bitcoin might be trustless in itself, but if it's being bought for fake dollars, its valuation in dollars will be fake as well. Whereas once we can trust that the dollars going into Bitcoin are real, we'll be able to trust that Bitcoin's valuation is real too. Why did I write this? Before my conversation with Bob, I was thinking about this problem in the abstract. There was a mystery to be solved. There was money to be made. But after speaking to Bob, I saw it differently. Through the eyes of a real human being, one who had taken the wrong side of this trade. There are millions of Bobs, all around the world. Many of them are leveraged up to their eyeballs in Tether on unbanked exchanges. Thousands more are buying into the trade every day. And almost all of them are going to lose their money when it all comes crashing down. This would be bad enough in ordinary times, but during a plandemic, it's catastrophic. With huge amounts of value for millions of people will be wiped out, individuals, families, and the most vulnerable among us will be ruined at the worst possible time. This isn't a game. The human pain will be immense, and the longer the fraud goes on, the more that pain will grow. I wrote this to stop the... Yeah, okay. Let's see, and some of the source materials I used in my investigation. Patrick McKenzie's excellent blog post gives a clear picture of the Tether situation up to October 2019. Matt Levine dedicated an issue of Money Stuff to Tether. Crypto Compares has helpful historical data on the volumes of different currencies flowing into Bitcoin, and I found the following Twitter accounts to be extremely insightful. Colorado Travis, Bitfinex is still around. Dr. Hosp1 and Bennett Tomlin and Patio 11. Note that Twitter appears to be intermittently suspending certain accounts that raise questions about Tether. There's a small chance some of the accounts listed here may become temporarily inaccessible. The content of this post is my personal opinion and doesn't necessarily reflect the positions of any individuals or organizations I may or may not have been affiliated with. I've chosen to post this anonymously, but I may decide to identify myself at some point in the future. Below is a SHA-256 hash of my real name, padded with random numbers. To claim ownership of this post, I'll use an account I control to publish the input string that holds this hash. So yeah, there you have it. It wasn't quite as much fun as I was anticipating, but it does put the onus where it should be, and that's on Tether. And I've said for a long time now that I believe their whole fraudulent thing, their whole governance and whatnot is completely fraudulent, and that their primary purpose is to suck US dollars back out of the cryptosphere. But that's just me. Anyway, let's go ahead and throw down with some music. And, we didn't get around to any Static X last time. I find that kind of weird. Let's go ahead and go with some Static X. And so, which song? Well, there's this one I really like. I'm going to go ahead and play it. Down by Static X here on Coin Metal. And that was Gorod with Haina. And so, as far as what else we're going to get into before the end of the evening, got this one here. It's on decrypt.co. IMF gives global governments a clear message. Spend. Will crypto remain pandemic-proof this year? And this is by Tim Hockey. And it's authored on January 16th, 2021. So, yes. Penis. Quote, spend as much as you can and then spend a little bit more, was the message given last night by the International Monetary Fund's Managing Director Kristalina Georgieva at Russia's annual Gaidar Economic Forum. One of the central topics at the forum was, as with everywhere else, was the effects of the pandemic on the economies worldwide. Georgieva praised Russia for its COVID-19 response, chalking the country's quick recovery up to the quantitative easing measures by its central bank, and to the $54.3 billion stimulus package from the Kremlin. Speaking to the rest of the world, Georgieva said, quote, "In terms of policies for right now, very unusual for the IMF. Starting in March, I would go out and I would say, quote, please spend. It is sage advice for a global economy calibrated by fiat money, though consumers could take the biggest hits. Inflation is likely to go up as more printed money drives demand for goods and services higher. Many investors think that cryptocurrencies offer a hedge against inflation. The theory goes that printing more money devalues fiat currencies, as seen in the Fed's pandemic response last year, when a massive printing of dollars brought the price of the American currency down. Michael Saylor says in a tweet, "Every investor is in danger of losing their wealth due to the great monetary inflation. We need a store of value that is not based in fiat. Bitcoin is the solution, an investment-grade safe haven treasury reserve asset." Whatever, dude. Trying to walk people into a wood chipper there. Unlike fiat money, some cryptocurrencies, such as Bitcoin, have their supply determined algorithmically, meaning that they remain outside of the market fluctuations of fiat currencies like the sterling and the dollar. Crypto enjoyed the spotlight throughout 2020, with market leader Bitcoin quickly recovering from the mid-March market crash before picking up the pace to flip its price from 4 to 5 digits on July 27th. It gradually jogged on all summer before breaking into a historic bull run in the last quarter of the year, when prices more than trebled from 10,500 on October 3rd to 33,000 by the second day of 2020, continuing on to hit second day of 2021, it should be, continuing on to hit its highs of just over $41,000. With governments across the world focusing their attention on rolling out vaccines and stimulating their economies, it will be interesting how the crypto economy will react. That's an interesting take. Personally, I think that it would be interesting to see if they do manage to take down Tether, just one of these stablecoins. If they managed to somehow get a hold of Tether and get them out of the cryptocurrency market, I believe that the demand for US dollars would go up versus cryptocurrencies, meaning that cryptocurrencies would appreciate in value versus US dollars significantly. Like, I've said this a multitude of times on this show, but you can literally see when USDT began being issued on any cryptocurrency chart. Start with Bitcoin if you need to, but if you look on an altcoin chart, any one of them, if they've been around for, I think it's like 4 years now, if they've been around for at least 4 years, you can see the difference in volatility on the pairing between that altcoin and Bitcoin. Now, whether or not you'll be able to see it versus the US dollar, I couldn't tell you specifically, but on the Bitcoin versus altcoin chart, like I said, you'd be able to see the difference between when people were trading specifically between altcoins and Bitcoin, and when they started trading them from altcoins to Tether, back to Bitcoin, back to altcoins, back to Tether. And like I said, you can see it. It's just plain as day right there. So I think that if it were to be nuked, that process would end and the volatility would return back over to the altcoin markets. Now, whether or not we'd see a similar effect on other quote-unquote stablecoins is another thing entirely. Anyway, I got a couple other little articles I wanted to get into here. And this one I thought was really funny because I've never understood algorithmic stablecoins, but supposedly they managed to maintain a real-life peg. I don't know. Anyway, this thing was authored approximately 7 hours ago, restoring algorithmic stablecoins to their peg. And let me see if they're... Oh, wait a minute. This was originally a Medium article. And this is by Eep. And I'm not going to make a guess as to sex there. Restoring algorithmic stablecoins to their peg. And over the past few months... Oh, this is originally authored on January 10th. There we go. Over the past few months, multiple algorithmic stablecoin projects have launched with the goal of creating a trustless, decentralized, and scalable store of value pegged to the US dollar. Hundreds of millions of dollars have been invested into them due to their highly speculative value, as investors can earn high returns from dividends when the price of the token is above $1 and purchase debt at a considerable discount when the price of the token is below $1. The problem: despite some initial success, none of the purely algorithmic stablecoin designs have managed to hold the peg for a sustained period of time. All four major pure algorithmic stablecoins, empty set dollar, dynamic set dollar, basis cash, and myth cash, are currently below their $1 peg. This is because the debt system those tokens rely on to raise the price back to the peg has failed. The debt systems those tokens use depend on enough people buying the debt bonds/coupons to return the token's price to the peg. If the price is not able to return to the peg, people who purchase bonds/coupons are stuck with useless bond/coupon tokens. A prolonged period of time where the price is below $1 decreases speculator interest, which causes people to exit and decreases the likelihood that the price will ever return to $1. This results in a death spiral where the price of the token slowly falls to zero. As Benjamin Simon said in a deep dive into algorithmic stablecoins, quote, "The moment there are no longer enough speculators who believe that the network is resilient, the network will no longer be resilient." The sections below will go over possible reasons why the two major algorithmic stablecoin designs are currently failing to maintain the peg: empty set dollar and dynamic set dollar. These are two that I've never even heard of before, by the way. ESD and DSD stakers didn't earn anything while the price was under the peg. That increases the likelihood that another money-making opportunity, like the release of a new project or rise in the price of Bitcoin, will cause people to sell their tokens and exit the platform. This results in the death spiral scenario detailed above. In addition to the flaws with the debt system mentioned in the previous section, the debt coupon system those tokens utilize is also unattractive to many people due to the possible risk of losing your investment forever if the coupon is not redeemed within 30 days, which requires the price of the token to return to $1. Basis cash/myth cash. Unlike ESD/DSD, basis cash and myth cash stake liquidity tokens to earn share tokens, which are received even while the price of the cash token is under the peg. Share tokens serve as an incentive for speculators to provide liquidity because they are staked in the boardroom, which receives a portion of any newly minted cash tokens. One of the factors that affects the amount of cash tokens minted is the amount the price is above $1. Consequently, the price of share token is based on the price of the cash token. If the price of the cash token is far above $1, the price of the share token will also be high, because the boardroom will receive a lot of tokens. The opposite is also true. If the cash token falls below $1, the price of the share token falls because the boardroom will no longer receive any tokens, which drastically reduces the income of liquidity providers. When they remove liquidity and exit, the price of both the share and cash token fall further, which can result in a death spiral as the platform becomes less attractive to potential liquidity providers. Solution: add incentives for people to buy/hold the cash and share tokens, provide liquidity, and purchase bonds when it is below $1. Add penalties when selling the token below $1. Any measures implemented should be as simple as possible. Overly complex mechanics can lead to unintended side effects and increase the gas cost of transactions, which would drive users away. Proposal: if the hourly TWAP of whatever the TWAP TWAP of the cash token is less than $1, add a tax when selling the cash or share token on SushiSwap or Uniswap. The cash token tax would be split between staked liquidity providers and the bond treasury, while the share token tax would be split between the staked liquidity providers and the boardroom. People who lock in their tokens in the staking contract would get a larger share of the rewards, and staking contracts would rewards the staking contracts give as well as the tax. Effects: adds an incentive for liquidity providers to remain staked since they will receive dividends from the tax. Adds an incentive for people to buy bonds since there will be a guaranteed payout waiting for them once the price of the cash token returns to the peg, unlike the current system where they have to wait for the tokens to be minted into the boardroom. Adds an incentive to remain staked in the boardroom and not dump the share token. A tax has a low impact on the gas tax or gas cost, while the TWAP is greater than or equal to $1. Both the tax and the locked staking would discourage panic selling and reward people for being dedicated to the platform even when yields are lower. The tax also makes whale manipulation more costly and transfers tokens from manipulators to honest actors. Bonus: the tax would prevent front-running bots from operating while the price is below $1. Unlike other proposed measures to maintain the peg, these measures are simple to implement and don't require constant governance. This is in line with the decentralized vision of algorithmic stablecoins. And there's no comments on it, darn it. Yeah, I think that along the lines of the original thesis in here about refraining from becoming overly complex, I think these kinds of governance relationships that this prescribes, I don't really see the appeal in them, to tell you the truth. As a matter of fact, I don't see any value in stablecoins at all. You know, as far as I'm concerned, if it's stable, it's dead. Anyway, it is with that I'd like to close out this episode. Thank you very much for listening. I certainly do appreciate the support. We will be back again on Wednesday at 8 p.m. Pacific Standard Time. And so until then, I want y'all to trade safe. Do your homework. And watch out for your own bunghole, because nobody else is going to do it for you. And as far as our last dance is concerned, I have not picked anything out. But I think we should go with Gizmochi. Burn. Last Dance here on Coin Metal. Thank you again for listening, and y'all have an excellent evening. Good night.